Most people think that tax optimization is this criminal thing that only the elites and the super rich do. But what if I told you that we helped over 500 entrepreneurs, investors, normal people and families save millions in tax revenue over the last 6 years? And none of them is particularly elite, to the best of my knowledge. Anyways, saving taxes legally is actually very simple. And my name is Ricardo Gorski. I'm the founder of Tax.One, where we help individuals and businesses pay as little tax as legally possible. And in this video, I'm giving you my full guide on how I reduced my tax burden from 50% down to just 2.65%. And to understand the full picture, we first need to start with understanding the different income types. There are actually 5 main income types, and each of them gets treated differently from a tax point of view, which means that we either have salary income, which is normal employment, meaning you work for a company and you receive your employment salary. Here, you usually pay the income tax rates, depending on the country you're currently living in, plus social contributions, healthcare, and many more additional contributions and tax rates that most people that work in a normal job are not even aware. The money that most people receive in their personal bank account at the end of the month is just the net income and not the gross income, which is usually and most of the times much higher. We are talking about sometimes even double the amount. And the worst part is that this income type is also the worst to optimize. But there are some solutions that I will explain in a minute. First, we continue with the next one, which is business income, meaning you have a company entity and then you're liable for corporate tax, which is very flexible. Also here, we will go into very detail in a minute what that means. We continue with a dividend income, meaning you have some investments that pay you dividends. That can be some public stocks, for example, but also your private company. And here we have the option in many jurisdictions to pay 0% with the right residency. Then we have interest income, which, for example, is money that you have in your bank account and you're receiving interest income from the banks. Here we also have many options where this is completely tax exempt, for example, under a non-dom status. And then we also have a rental income, which is usually locally taxed in the property's country. Beyond these, we obviously have many more income types, but we will stick with these ones as they are the most common one and most likely also apply to you. And what you need to know as well is that the working class pays the highest effective tax rate. So people that just receive salary, and this is not because they earn the most, this is actually because they can't really restructure their setup. And so in many cases, they end up paying up to 50% in taxes and sometimes even more. And so this perfectly leads to our first main chapter that we are going to discuss, and that is that companies are the foundation for tax optimization. And even though our main clientele is business owners or entrepreneurs with their own company, there is still the option for a normal person working a normal job to restructure their setup from receiving salary to invoicing through your own company, your employer. And by doing that, we achieved a very important goal for tax optimization, and that is that we changed the definition of our income from employment to business income, which then unlocks many options such as corporate tax optimization, expense deduction, profit shifting, as well as receiving dividends, which is much more tax favorable than the salary tax rates. How could this look like in real life? You're going to sit down with your employer, have a conversation, you explain to them that you don't want to receive salary anymore, but you're going to incorporate your own company. You're going to act like a contractor, send them invoices, and nothing else will change in your working routine. And then, since you need your new company entity, you have the option to choose where you will incorporate the company, and that directly controls your corporate tax rate. Logically, you would rather choose a jurisdiction where the corporate tax rate is as low as possible and not the high tax rates of 30%, which many jurisdictions have as well. And so what you will most likely do is you will own a foreign company, which, by the way, is fully legal. And the chances are high that you actually own a foreign company. There is nothing shady by owning foreign companies. Even if you own Apple shares, you also technically own a foreign company, but obviously just a tiny fraction. And so now let's look at the 3 most popular offshore jurisdictions that our clients choose. countries. Number one, we have Cyprus, where I personally reside in as well. And since January 1st, 2026 this year, the corporate tax rate is 15%, which is a great thing because this is OECD aligned, meaning it is fully compliant with international tax law. If a company pays at least 15% in corporate tax, then the company is fully operational. You can open up bank accounts in any country or in most countries. You do not have the risk of being flagged, grey-listed or blacklisted. But now it's getting interesting because the headline corporate tax is 15%. However, Cyprus also offers the IP box regime, which means that you can lower your effective corporate tax down to just 3% on IP-related income. My friend George, for example, is a great example for that. He's the founder of Shrine.io, which is a Shopify theme, one of the biggest ones, and his corporate tax here in Cyprus is 3% on all income that he generates through royalty income or software-based income from Shrine.io. And this is the main reason why specifically software companies actually love Cyprus to incorporate, and because they have the option to have such a low corporate tax rate, even lower than Dubai and Malta, which we'll talk about in a minute as well. But first, let's discuss a few more benefits of Cyprus, and that is that it is a EU member, meaning you have EU banking access, you can use the IBAN banking infrastructure. Cyprus has a strong reputation nowadays, and the low setup and maintenance costs are also a reason why many people incorporate here in Cyprus, just because it is very affordable. So to summarize, a Cyprus limited company is great for software businesses, IP income, holding structures also very favorable with specific benefits, and also operating businesses in general that are fine with paying 15% in corporate tax. Next, we have the UAE, which consists of 7 emirates, each of which have their own tax laws, policies and rules. One of the most popular emirates is Dubai, which I also spent a lot of time in, and the federal corporate tax is 9%. However, as the emirates such as Dubai have many free zones, there are also specific tax exemptions, such as the small business relief, which means that you can pay 0% in corporate tax up to 3 million dirhams in revenue until the end of 2027. However, there are rumors that this will be extended. We will see if this is going to happen. I will definitely update you here on this channel. However, there are some disadvantages when it comes to the UAE, such as the double tax treaty, which is not existing with US or Germany. That means if you generate, for example, income from the US, such as AdSense, which is a very common thing for many entrepreneurs, even myself, then there is going to be applied a withholding tax, which means if you generate money from America, then Uncle Sam will keep some of the money and you will not even see it in the first place. The problem with the non-existing treaty between the UAE and Germany is that German citizens that live in the UAE or have lived there for many years, is that if Germany would ever impose a global citizenship-based taxation or worldwide income tax, anything of that sort, then the German Finanzamt could go after Germans living in the UAE and maybe even require tax declarations from previous tax calendar years, and maybe there would be a back tax, which would literally be the worst case scenario. How this would unfold in the case of, no one really knows as of now. Maybe nothing will happen, but I'm just telling you that there is the risk of such a scenario. However, in general, there is a 0% personal income tax in the UAE, meaning all your income would be generally tax-free. But again, personal income tax is one income type, it is not corporate tax, and so we would definitely need to look into your current setup, how you make money, and what applies to you. Lastly, Malta, also definitely interesting because of the fact that the headline corporate tax is actually very high, and that is 35%, one of the highest in the world. And this corporate tax needs to be paid upfront by every company. However, Malta did it quite smart because they actually have a refund system where 6/7 of the tax that you paid will be returned after distributing dividends, which leads to an effective corporate tax of 5%, which by the way applies to all business income, not just software or IP. However, the catch is that this refund only applies to dividend distribution to non-domiciled parties, which then indirectly forces you to incorporate a second company outside of Malta, which would receive the dividends. So you would need a holding structure that leads to you running 2 entities, 2 accountings, 2 filings, 2 books, and that would double or maybe even triple, depending on the jurisdiction that you choose, admin, work, and the related costs. Now, other than that, there are obviously also many more jurisdictions, 40, 50 in total, which a lot of people advertise online. However, the problem is that many of those setups come with their own risks and problems, and so they are often misused, and we generally never recommend to incorporate in Hong Kong, use a Caribbean structure, US LLCs, because a US LLC, for example, is not even a corporate entity. it is a pass-through entity, which leads to you ending up paying personal income tax and then in many cases not being fully tax-free. Another tax haven option would be Panama. However, just the word Panama lost its credibility through the Panama Papers. And so what many people don't understand or don't want to understand is that a lot of those jurisdictions are pure paper residencies. The same applies to Paraguay, Vanuatu, which have so many banking issues with so many more issues that you don't want to encounter in your business world. The thing is that there is a huge difference between a tax haven and a low tax jurisdiction with an established legal framework and international credibility. And even the big four, KPMG, PwC, Deloitte, Ernst & Young, even those big advisory firms that literally know everything about tax optimization, they usually stay within those credible and treaty-backed countries because they know the risks that come with these DIY setups and structures, which are usually used in viral marketing campaigns through social media, but the actual risk is never really explained thoroughly and oversimplified. But that shall be it for now about the corporate taxation, and I know there is obviously much more that we need to discuss, which we can do in an individual consultation call based on your personal situation. What to do with an existing company? Should you shift it to another jurisdiction or just incorporate a new one? But that would be too much for this video just because it is super individual, and what comes now is even more important because we definitely have to talk about substance and why it beats paper structures. Once income flows through a company, a key risk appears, which is why most people stop with tax optimization right away. They say it is not possible because of that, despite the fact that this risk can be managed properly. And obviously I'm talking about CFC rules, controlled foreign companies, and this is where most DIY structures you find online completely fail. The thing is that the country of incorporation actually doesn't matter. It is totally irrelevant. What actually matters is the country of management and control. And so without proper substance, CFC rules do apply, and your home country or the country where you have your personal tax residency can tax that company anyway with the local tax rate. Just like a natural person, you and me, also companies have their tax residencies, and you need to make sure that the tax residency is in the jurisdiction where you want to have it. To make it even simpler, let's get back to the Apple example, and that is if we own Apple shares, we own a tiny fraction of a foreign company. However, as we do not manage or control Apple in any way, the tax residency and tax liability of Apple stays in the US or in Ireland for their EU income because they also have their very own tax optimization structure. Now coming back to your setup, to avoid your foreign company from being taxed locally, which would eliminate all tax benefits, you need substance in the foreign company that proves to your local tax authorities that your foreign company is also being managed and controlled in that foreign jurisdiction. And so now a few solutions that will achieve that, and that is we usually start with hiring a local resident director, not a nominee, under an engagement letter basis. That person needs to be a legal tax resident of that jurisdiction, receive a real salary at market standard, also equivalent to the company's turnover, draft, prepare contracts, for example, and in general have decision-making power over the company. The problem with a nominee is that it is usually just a randomly appointed person with no remuneration at all, no expertise or knowledge in the business activity, which is something that advisors did many years ago before the UBO, the ultimate beneficial owner transparency register, was implemented. An actual local director is a person that also cares about the business. He does certain activities that are defined in a contract, receives an actual salary with social contributions, has access to bank accounts, and is also present at local board meetings, for example, with the actual UBOs. And if we would want to scale it up, depending on the business size, then we can also open a physical office, we can hire employees, and have real local activity. Such measurements would remove CFC exposure even further and makes the whole structure really bulletproof so that everyone can sleep well at night. And for that, I actually have a very good example of a client of ours that is from the Netherlands. He runs an e-commerce shop, has about 30 million in annual turnover. His profit margin is very high, above 80%. And the thing with the actual shareholder, this one person, is that he's traveling a lot. He's selling selling fashion and jewelry online, and what we now do is opening a local store for him where he sells some products of his collection. We incorporated a Cyprus limited company for him and his business, which means that he's now liable for 15% corporate tax, which already almost halved his tax rate in corporate tax terms, because he's not liable for the Dutch 26 corporate tax anymore. And now it's getting interesting, because yes, he's selling online, but with the physical office here in Cyprus, customers can also go into the physical store here in Cyprus, buy his products, and when the owner is coming here to Cyprus, we obviously have board meetings, we discuss key decisions for the business, we have local staff here that work in the shop, and they also from the shop manage the Shopify store. And this leads to the goal which we want to achieve, that the business is now a tax resident of Cyprus. But in this specific case, we work with a so-called hybrid model, where the business of the client still has certain collections under the original Dutch company for 3 reasons. Number one, we realistically can't just wind down the Dutch company from one day to another. We need to slowly and realistically transfer all operations outside the country over a time period of a few years. Also, many of his Dutch contractors, suppliers, payment processes, logistic partners, B2B contractors still have active contracts with the Dutch entity, and so a new entity in another country would eliminate certain contracts that need to be in place. And so if you run a multi-million business, then chances are high that you have such multi-year agreements that come with termination policies or penalties, for example. But if you run a solopreneur business and you just have one client, for example, then just winding down your company, depending on the turnover, is much more realistic, and you could just incorporate a completely new company. However, point number 2 is that completely abandoning your original company, or in this case, the Dutch company that previously declared millions in revenue, this could trigger a manual audit or maybe even trigger exit tax. But by keeping a part of the business running in the Netherlands, say a specific product line, for example, the client continues to file Dutch returns, pays some corporate tax locally, signals actual commercial interests and activities instead of just saying, peace, I'm out. What the tax authorities usually want to see is a continuing taxpayer that pays the taxes on time, everything clean, and if the revenue goes up and down or down and down in revenue, this usually doesn't trigger a manual tax audit as much as someone that just runs away, because also you need to know that the tax departments in many countries can look into previous tax calendar years retroactively, and no matter where you live, they can require you to send your tax audits for previous tax calendar years to your home country or country of residence where you currently reside. And depending on which country we talk about, this can be very strict. Anyway, number 3 is that his Dutch customer base trusts a local Dutch company, obviously with a Dutch VAT number, address, returns policy, imprint, consumer protection, anything there is. In e-commerce specifically, it is very important that trust is there, and if someone sees that the company is situated in Hong Kong, trust usually is not really given as much as when it is a German or Dutch company where the consumer also lives in. But again, this is very, very individual. If you're, for example, into B2B and you are in close relationship with your clients and you explain them why you have that company, then this most likely will not really affect you. And this is why I always say definitely make sure to book your individual consultation call at Tax.One. And also, very, very important is that there is no official guideline or playbook that defines the exact requirements for enough substance. So what we just discussed is what we usually do for and with our clients in order to prove as much management and control in the jurisdiction where you want to operate your business in. And the reason for that is because substance is a very broad term. It highly depends on how your business actually operates in real life. And it is literally not the tax department's business on how you personally run your business. Because if you have an answer to why you're going to incorporate the company in that country, then it is your responsibility and your decision how you want to structure the board, how you operate your business or not. Tax authorities only review and evaluate, but they cannot interfere with your personal business decisions. And this obviously gives us a lot of flexibility. So let's now discuss the best practices when it comes to management and control here in Cyprus. Number 1 is that the majority of the board, so the directors, shall be Cyprus residents. It does not mean that you cannot be a director in your Cyprus company. It just means that the majority should be Cyprus residents. If you're the sole shareholder of your business and you run a small to medium-sized business and you appoint me and my business partner to be directors at your company as well, then we are going to be the majority because we are tax residents here in Cyprus and your company fulfills the first best practice. Number two is very important, and that is that board meetings shall be physically in Cyprus. So every now and then you come here to Cyprus, we meet in our office, in your office, in any office, and we discuss business decisions and we actively work on your business. It's important to understand that this is not tax evasion. This is a joint venture. We do not onboard every client that wants us to be their directors or that wants to incorporate a company here in Cyprus without physically moving to Cyprus as well. We mostly onboard clients that are really interested in working with us, trust us, start a joint venture and a long-term business relationship. Because the local director is also fully responsible for the company, and so the directors are active and accountable and never really passive. We do the accounting of your company, we take care of the audit, we have hard copies kept in Cyprus of every important document, we open and operate bank accounts from Cyprus, and those are the things that actually provide substance, management and control. But again, this is not an official checklist, this is just the best practices, because substance is, at the end of the day, judged by how a business actually operates, which is very individual. And before we continue with talking about how you actually cash out the money from your company, first let's discuss the fact that there is obviously much more further optimization that is also possible with holding structures, for example. But I can't emphasize enough that tax optimization is probably one of the most individual services one can receive, and there is no real universal perfect setup. There are so many more keywords and buzzwords and things we can't ignore, such as transfer pricing rules, for example, because a lot of people think, I'm just going to issue an invoice from company A to company B and just shift all of my profits to the lower tax jurisdiction. But no, this is not possible. What you generally need to understand is that already earned money is subject to the old tax rate under the old company. We can only do tax optimization from today, and this is why it is important to start as early as possible before you scale to millions and millions with the right setup. Legal tax optimization only applies to future income, which is the reason why you should have the right and correct setup right from the beginning, and this is also the reason why we could save millions, literally, in tax revenue for our Dutch client if he would have come to us a few years earlier. And then finally, in addition to tax optimization structures, so in addition to the holding structures which are purely for tax optimization, many clients, especially high net worth individuals and family offices, for example, they also choose to add or incorporate trusts, foundation, charities or similar vehicles that are very, very unique to create a clear separation between them and the corporate entity, so they are invincible within information exchange frameworks such as the CRS, for example. However, the main goal here is discretion and wealth protection and not really tax optimization per se. And even though it is such a complicated topic, the most important thing to understand is that if structured correctly with the right partners and advisors, then it is not just fully legal but also completely compliant and possible. Yes, even for you. And now, once a company or the companies are structured properly, it is time to funnel your income and wealth inside that corporate entity. And this is where long-term wealth is actually built. Because once you operate within your new company entity, then the money inside the company can be reinvested into the business, obviously, used for legitimate business expenses. You can deploy it into assets such as property, equities, etc. And you can just compound your wealth in a low tax environment. But even though your wealth grows inside that corporate shell, so to say, it is not really personally yours yet. So you do not have it in your personal bank account, because when you want to personally extract it to your bank account, then personal tax applies. Yes, you can issue a business credit card, for example, and use it however you want. For business travel expenses, for example, Cyprus is very, very coherent with travel expenses. So for our clients, we usually are able to claim most of the expenses that you have outside the country as a travel business expense, which means that you can further reduce your profit, so you pay even less taxes at the end of the day. But the thing is that we are tied to keeping the money in a corporate entity, meaning me, myself, Ricardo Gorski, as a natural person, I do not own the money or assets yet. Yes, I do own the company which owns these assets, but it is a little bit different because I cannot simply transfer the money from my business bank account to my personal bank account. But also this is possible, and we are going to talk about how in a minute. First, we need to talk about your existing wealth and how you can move it out the country without triggering specifically exit taxes. Because the hardest part is not building in a low tax environment, as we learned already. It is moving your existing wealth out the country. And here we need to take a few things into consideration, such as the double tax treaties and the exit tax rules of the country where you currently reside in. The good news are that from Cyprus point of view, Cyprus holding companies can receive dividends from EU subsidiaries at a 0% tax rate. And if there is also no withholding tax from your country of residence, then it may be possible to shift shares or cash without triggering any taxes. But here we see the already discussed buzzword, which is transfer pricing, which is, to no one's surprise, very individual. As another example, we have an Irish millionaire as a client. He's considering moving to Cyprus in a few years from now, but as of now, he needs to stay in Ireland for personal reasons. So what we did for this client is we created an environment where he's able to now shift his assets slowly out of Ireland in compliance with HMRC via a share-for-share exchange. He shifted his assets, specifically cash, here to Cyprus, which he now uses to invest into Cyprus real estate. And by doing that, he's not just building his real estate portfolio here in Cyprus, but also legally not paying the taxes he would have paid if he would keep the cash in Ireland, which would be something around 30%. So while he's buying the properties here in Cyprus, he always has in the back of his mind that he's buying the properties realistically and factually with a 30% discount. And we actually have this specific share-for-share exchange template in our records. It is like over 100 documents that we presented to the HMRC that this specific line was able to do this structure. And for every country, depending on where you are from, there are certain things that you need to watch out for. In Germany, there's the exit tax, which applies to the company value, including unrealized gains. In the UK, it is the long-term residency rules, so the 5-year tax trail. And when it comes to inheritance tax rules, you even have an exposure of up to 10 years. And in the US, it is obviously the citizenship-based taxation, which there are only two real solutions to, and that is either you renounce your citizenship or you just accept the fact that Uncle Sam always will get paid regardless of where you live. And we actually went through all those processes. So we have clients from Germany, a lot of clients from the UK, we have clients from the US, clients that actually renounce or are currently renouncing their citizenship because it is a very long process, and clients that just kept their US passport and accept the fact that they are always going to be paying some money to the US. And now, before we continue with the final piece, the personal tax residency, let's just talk about the fact that certain assets and certain taxation may not be really optimizable, such as local real estate. Usually you cannot escape local taxation on rental income or capital gains because the property usually gets taxed in the country where the property is. And with that being said, let's continue with the personal tax residency, which is very, very important, maybe even the most important thing, because now we shift from the taxation on the corporate level to the personal level. Most people on this planet have a personal tax residency to one specific country, and the general rule is wherever you spend more than 6 months, you are the tax resident of that country, and you need to file your personal tax returns in that very country. Yes, I'm aware of people that claim that they are a tax resident of no country. However, we also have two cases where individuals wanted to buy a property here in Cyprus, but they couldn't provide tax residency certificates of the previous years, and so there was never really an audited tax return, and this individual was not able to buy or operate within such a framework which requires proper KYC and AML. So general rule of thumb is wherever your life center is and you spend more than 6 months, this is where you pay personally taxes. However, in real life, it is a bit more complicated than we would wish, and that is because certain countries where you want to have your tax residency, aka low tax jurisdiction, it is much easier to get your tax residency there than to not get your tax residency in a country or jurisdiction where you do not want to have it, aka a high tax jurisdiction. And that becomes even more complex when we are talking about stricter countries such as the UK, Germany, Scandinavian countries, because some of these countries see you as their tax resident under different definition, under their own weird rules, such as you spend 90 days in that country. Or the UK in some cases already sees you as a tax resident if you just spend 15 days in the first year after leaving. It also depends where your family lives, goes to work, goes to school, etc., where you have properties, what kind of properties are they just for your family, yourself maybe if you're in the country, or are you renting them out? And also even things like where you have cars, what kind of cars? Do you use the local infrastructure or services? Do you have a gym membership? Do you have a local SIM card? All those things are points which the tax department could and will look at to determine whether or not you are still their tax resident. But again, unfortunately, there is no official guidelines by which you have to act. That's why it's very important to have professional advisors that tell you exactly how you should structure your exit strategy so that in no case you would still trigger tax residency where you do not want to have it. And I know for many people it is harder than they would wish it to be. And even myself, it was not easy to leave Germany and everything I knew my whole life behind, my family, my friends, my environment. And so I know exactly how you feel, but I'm also telling you that there are solutions. I haven't been a tax resident of Germany for over 7 years now, because every single year I get the tax residency certificate here of Cyprus, and so Germany can't do nothing. And again, I'm aware that there are people out there that claim that you are not necessarily in need of having a tax residency. You can just travel the world, not spend more than 6 months anywhere, and you basically are tax-free. But I have a separate video explaining exactly why I do not recommend this, and you can watch it right here. And so what we much rather recommend to people that travel a lot or do not want to spend more than 6 months in a specific country is the Cyprus 60-day tax residency. Cyprus actually has a special 60 days residency rule, which many of our clients take advantage of, and you can claim this special tax residency as well if you spend 60 days per tax calendar year in Cyprus. By the way, the Cyprus tax calendar year is January 1st until December 31st, which is different to the UK tax calendar year, which is like April to March. But then in addition to that, it is also important to not trigger any tax residence in another country, meaning do not spend more than 183 days in any other country, or do not trigger tax residence in a country, depending on those definitions, whatever it is. As we discussed here, we shall definitely speak to you individually to make sure that you do not trigger any other country's residency. So many residence words. But the last requirement is that you shall also have a permanent home in Cyprus, meaning have a rental contract that is 6 to 12 months. We could look into your individual case, what would apply to you, and also have a business here in Cyprus. And ideally, that would be a Cyprus limited company that you then use for your business. And so as soon as you fulfill these 3 requirements, then on day 61 we can go to the tax department here in Cyprus and issue your tax residency certificate, which you then keep in your records, and you can present to any tax department outside of Cyprus that wants to tax you, and you tell them, look, I paid my taxes here in Cyprus, I'm a tax resident here, leave me alone. And in addition to that, Cyprus also offers the non-dom status for people that haven't lived in Cyprus in the previous 17 years, which most likely is every one of you unless you're Cypriot. And that non-dom certificate is a EU-approved certificate that legally exempts you from dividend and interest income taxation for 17 years. You only have to pay 2.65% to the healthcare contribution, YESI NHS, which is also capped at 4,770 euros per year. So that is the maximum that you pay, even if you receive millions in dividend or interest income. And also another benefit of Cyprus is that we have over 60 double tax treaties, including the US. So even your AdSense income is not withheld in the US, but you only pay 15% corporate tax here in Cyprus. And yes, I know Cyprus is not the only country with such a non-dom status. I mean, even Malta has a non-dom program, but what I don't really like about Malta is the fact that it is based on remittance basis. So only the money that you keep outside of Malta is not taxed, but as soon as you remit it in Malta, so you shift it to a Maltese bank account or you spend the money, then it is actually taxed in Malta as well. Ireland has a non-dom program. The UK used to have a very interesting non-dom program until recently, before politicians destroyed it, and now the UK is suffering from one of the biggest wealth exoduses in decades. Portugal had a very good NHR program, but also this was reformed recently and is not as attractive anymore as it used to be. Paraguay, Vanuatu claim to have a tax residency without visiting the country, but this is, as we learned, a paper residency and limits you in many ways. You will get off-board at any major bank as soon as they require you to send your KYC see information. And so, of course, all these Western countries realize that the wealth exodus is actually real, and they are losing many entrepreneurs and wealthy people to such low tax jurisdictions that are doing everything right. They are missing out in billions of tax revenue every year. And so the only real risk that you and me, if we shift our company to a low tax jurisdiction or even relocate in many cases, would have is if our original country, our passport country, would impose a global citizenship-based taxation or a worldwide income tax. And I personally, unfortunately, see that as realistic in the next few years. France already tried to implement it, but they got a lot of backlash pretty fast. And even if the leaders of the world say that this will never happen, and don't worry guys, we may still end up wearing masks. And so again, don't get me wrong, I'm not saying this is going to happen next year, but I'm telling you that there are people out there that collect new passports, they take care of their dual citizenship, they invest into countries like St. Kitts and Nevis just to make sure that they have a plan B. Even if there would be a global citizenship-based taxation, they can then renounce their original passport and do not pay taxes under the new passport that they obtained. But for now we are safe. I live in Cyprus under the non-dom program. I have a Cyprus limited company and a Dubai free zone company for a specific part of my business where I take advantage of the small business relief, meaning I pay 0% there, 15% here, receive the dividends as a natural person, pay 0% on my dividend and interest income. And as of today, this works and is 100% legal. And so if you're now interested in speaking to us, definitely make sure to reach out to us on Tax.One. You will get an automated email as soon as you fill out the form, and we are able to help you as good as possible with your tax optimization. And if you subscribe to the channel, then I will see you in the next video.